morning and welcome to a brand new day here on ausbiz. This is the Global View. I'm Nadine Blaney and it's wonderful to be here with you on the 15th of October. We are gearing up to bring you coverage from the Australia and New Zealand City Investment Conference. We've got our camera crews there and looking forward to chatting with guests from that event throughout the session today. Safe to say it was a record finish on Wall Street for the S&P 500 and the Dow Jones Industrials. We saw tech really leading the charge. NVIDIA once again into positive territory, Apple and Microsoft as well. So let's find out if this momentum can continue. And for that, Steve Sosnick is joining us from Interactive Brokers. Steve, hi, welcome. One of my guests earlier today just said the bulls are in charge and there are no breaks at play at all. So what's the story?
Good morning, Nadine. Great to see you. It's been a while.
Yeah.
Yeah, that's really that's a great way of putting it. I mean, today, I basically wrote a piece this morning saying, this is another test of Newton's first law. Body in motion stays in motion until acted upon by an outside force. There were no outside forces to act upon it today because it was Columbus Day in the U.S. and happy Thanksgiving in Canada to you.
Mm-hmm.
But so there wasn't really much going on. Banks are closed. The government was closed. Therefore, the bond market was closed. So, stocks were left to their own devices, and very much the trend has been up. And what we've seen over the last couple of days, weeks, we've been asserting that basically traders are fitting whatever the data points and the news are to their preferred narrative, and their preferred narrative is take the market higher.
Okay, so if the market continues to be taken higher, does it mean that we will continue to see a widening out of the breadth? Because I'm just very cognizant that we've got, quarterly earnings coming through as well, which feels as if it's still going to be putting the spotlight on some of those, the tech names, the AI names, those that have benefited from the prevailing narrative throughout 2024.
This earnings season is really going to be key because it's really all about guidance. We saw JP Morgan and Wells Fargo rally because the guidance was pretty good. JP Morgan was a bit better overall, but then they sort of said, let's not get ahead of ourselves on net interest margins. But still in all, the market liked what it heard. Wells Fargo really actually wasn't that great of a number, but they alluded to the fact that some of the government deposit caps that were put on the stock after some of their regulatory shenanigans might be coming off in the near future. So that was good enough to get it to lift. The bottom line here is on a quarter over quarter basis, the overall consensus is for about 4% growth in earnings. But as we've been saying all along, the EPS number really isn't a sufficient reason to rally anymore when 5 to 80% of the companies beat on a regular basis. You need to beat if you want to rally, but you really need to get your guidance up or keep your guidance high. The reason being because next year the prevailing wisdom is for about a 15% year-over-year rise in earnings. We need good guidance to achieve that. We also need a good economy, and actually more so than rate cuts. But the idea of throwing rate cuts on top of an economy that's still growing about 3% might be able to achieve that. But there's a lot baked in, and that's really going to be the key. If a wide range of companies can keep the faith with investors, then we will see the market broaden out. If not, then you probably do see markets revert to their old favorites, the big tech stocks. And of course, if those stocks kind of slump on guidance, I don't know, good luck with that.
Yeah, okay, so it's all about the guidance. And I mean, do you think that the US economy is strong enough that many of those companies will be able to offer clear guidance? I know that here in Australia, in our most recent reporting season, CEOs were much less inclined to offer guidance than they had been previously. So, I mean, is this something that is purely expected from U.S. companies, or is the option always on the table to not give guidance?
And therein lies the problem because the option is on the table for them not to give guidance, or at least, be very vague with that guidance. It's really tough right now because, the Fed is sort of an unknown. Yes, they're planning to cut rates, but the markets may be ahead of the Fed once again in terms of the pace of rate cuts. The economy is good. You're looking at, again, the Atlanta Fed GDP now numbers 3.2 for the coming quarter when I last looked, which is a solid economy. You're still looking, at 4.1% unemployment rate, which is a sign of a good economy. You started to see CPI tick up a little bit, monthly hourly earnings tick up a little bit, which, puts a little pressure on the prices paid. And then again, no one knows what to expect from the coming election. So it would behoove a lot of companies to be sort of conservative in their guidance, but that may or may not be what the market wants to hear. I'm guessing the market wants to hear something a lot more exuberant than sort of the cautious optimism that I think a lot of companies probably feel more comfortable giving.
Okay, so then you do, insofar as saying that, expect that there could be some hiccups throughout this quarterly reporting season, Steve.
Yeah, and I think you see that in terms of the VIX, where we're a bit lower than we were. We were below 20 today, but it's still relatively high based on recent events. Part of that has to do with the fact, by the way, that we've been going up and down, though more up, but by 1% a day on some days, and so VIX should be relatively elevated. And of course, you do have the election coming up, which behooves people to maybe do a little volatility hedging. But yeah, that's really the key here is it, we're banking on so many things to go right at this point. The valuations are high. They're not excessively so, but when we look at comparisons, we're talking about 2007, we're talking about 1999. Those are fairly auspicious time periods when it comes to um, valuation. So we really do have to have almost to thread the needle or have a perfect storm here. Can we do it? Sure. But I do think that's why, if there will be companies that just either can't or won't give the type of guidance that the market is looking for, and those will be problematic. The question is, how many of them will there be? There's always some. So that, will it be prevalent or will it be sort of an outlier? And will they be big, important companies or sort of companies that the market can overlook? And that's really what's going to set this earnings season up to be particularly challenging.
Yeah, and then of course that takes us to the election. We'll leave that one there. I don't think we've got time to go through all of the different scenarios. But any thought on where you're seeing a lot of volumes going through on the tape, Steve?
Yeah, well, at our shop, Nvidia and Tesla are the perpetual number one and two. Tesla actually had a bit of a kick up because the anticipation into the robo-taxi event and then the disappointment. And the chart you're showing here is kind of my thesis of that Tesla could be divided into two eras or epochs. Before Twitter, BT, and AX after X. And the first vertical line is when Elon Musk started talking about he's announced the potential to acquire Twitter. You could see that was pretty much an all-time high. By the time he got around to doing the deal, the stock and the market had sold off quite a bit. And when you fast forward, we're essentially unchanged in the period since he owned Twitter, and actually down quite substantially in the period since he started talking about it. So we could spend hours discussing why that might be. It's hard to run other companies. Being a social media magnate is different than a technologist, et cetera, et cetera. But the bottom line is, Nvidia captures everybody's imagination. Tesla has continued to get people excited and not excited. And very recently, we've had a lot of activity in Chinese linked names because of the stimulus. When you go up 25% in a week and then try to go higher and then come back lower after some disappointment and then have some remarkable volatility. There's a lot of activity in the Chinese names that trade in the U.S. Alibaba, Neo, JD, et cetera, et cetera.
Yeah, and those were some names that suffered through the overnight period as well, just with the unknowns around the Chinese stimulus. Steve, we could talk forever, but we'll have to leave it there for now. Nice to see you again, and we look forward to speaking to you soon.
Great to see you too. Talk
Take
soon.
care. Steve Sosnick there from Interactive Brokers, and he was live in New York, or just outside New York. So those fresh record highs being minted for the U.S. markets, the S&P 500 and the Dow Jones. We did, though, have bond markets closed for the Columbus Day holiday. NVIDIA, as we were just talking about, rose. Apple rose. Microsoft rose. A bit of a dampener put on the Dow, though, by Caterpillar after a downgrade, and Boeing as well. I just mentioned those Chinese firms that came under pressure, Alibaba and also PDD Holdings, down pretty significantly in that case, off by 6%. Top 5 stocks, I thought it's always interesting to look at these. Vistra, Momentum Holdings, Qualcomm, and Delta Airlines. Bottom 5, though, Albemarle, so yeah, in the lithium space, Dollar General, CrowdStrike, and Arch Capital Group amongst the losers. Neil Kashkari was out speaking, saying that he sees modest interest rate cuts ahead as the central bank's 2% target looms, and citing a recent uptick in inflation and data showing the U.S. economy and labor market are stronger than previously thought. Fed Governor Christopher Waller called for more caution on interest rate cuts ahead, noting there's considerable room for easing the Fed's restrictive policy rate. We are expecting about an 86% chance for a 25 basis point cut coming in November, according to the CME. And we saw the US dollar gaining ground, the Aussie dollar sitting at 67.3. And then, just for interest's sake, I found this chart. More dollars are pouring into the 2024 election cycle than any other in American history. On a nominal basis, with only weeks left until the election day, Open Secrets, which is a nonpartisan nonprofit that tracks money in politics, estimates that total spending this cycle will hit $15.9 billion, surpassing the record from 4 years ago in nominal terms again. Boy, how that money could be spent to help people. Interesting thought. All right, before we go, we're expecting to see the local market rise by about 37 points at the open, or close to 0.5%. So hitching a ride on that momentum coming from Wall Street. I'll get you across all the details next.